Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. My guest on today's podcast is Jeff Cardone. Jeff is a partner at Luce Gorman. Jeff specializes in helping credit unions and other financial institutions with mergers and acquisitions, executive comp, employee benefits, and tax planning. And in this episode, we discuss subordinated debt, including the new rules on subordinated debt, the approval process, and why your credit union may want to consider getting pre-approved to issue debt if necessary. Jeff, welcome to the show today. I'm excited to learn about subordinated debt. So tell us, what is subordinated debt? How do credit unions use it?
Doug, great pleasure to be here. Well, I always like to start when I talk sub-debt, particularly to credit union management teams and boards. What is it in the practical sense if you're a credit union? It's really a borrowing. Credit union is borrowing money from investors, but the structure of the loan, the term of the borrowing is structured in a manner that it gets favorable regulatory capital treatment. I mean, that is in essence what sub-debt is. You're going to find investors that's going to be issued to. Credit unions borrowed money. Now, the typical terms of sub-debt to get, when I say favorable regulatory capital treatment, sort of the why credit unions would want to do this. One, if you're low income designated, it's accretive to your net worth. I mean, that is the beauty of sub-debt. So when you go out and raise it and you're accessing the capital markets and you get those funds, let's say you raise $10 million, that immediately enhances your net worth by $10 million. I would say that's been sort of the why this is happening. And it's gotten a lot more attention because the NCUA adopted, final rules that are going to go into effect 1/1/22. And what that final rule has done is, one, it's sort of formalized the sub-debt process. But secondly, it's broadened the who. We're going to what, why, and who, like who can issue sub-debt. Where currently it's only if you're a low income designated credit union, you can access the sub-debt markets. That's been in place since the mid-90s. What the final rule has done is sort of expand the pool of credit unions who can access the sub-debt markets. And what the final rule calls them is complex credit unions. And these are credit unions that are 500 million assets or greater. So larger credit unions will now have the ability, even if they don't have low income designated status, to access the sub-debt markets as well, starting in 1/1/22. And we can kind of get into the process of that and so on and so forth. But that's kind of what's going on. And one thing I'd add too is, and this is also very important as well, because I get this question a lot. Credit union boards will say, well, the sub-debt, is that sort of a sign of weakness if we have to raise capital vis-a-vis sub-debt? And I would emphasize that is no, absolutely not. I will tell you on the bank side, banks are doing sub-debt hand over fist. And they're raising capital vis-a-vis sub-debt, and because the rates are so low, it's been a great market for that. So absolutely not. I think credit unions can utilize sub-debt, for offensive purposes, whether growing, organically or through M&A. They can use it for defensive purposes to enhance their regulatory capital, to provide liquidity for the institutions. So there's a lot of really good reasons as to why credit should at least explore this.
Interesting. So with interest rates being at a low point, if you're locking in a long-term fixed rate of interest, that's an appealing idea. What are the terms like for sub-debt?
So a few requirements to get favorable regulatory capital treatment. Generally, the debt can't be callable for at least 5 years. So in other words, like once it's out there, you're basically locked in at a minimum of 5 years before you can redeem the sub-debt. That's a requirement to get regulatory capital treatment. And typically, the rate is fixed for the first 5 years. And then thereafter, it kind of converts to a floating rate. And typically, the max term, I think, is 20 years in terms of when it can be redeemed. So it's generally you're locked in for 5. And in most of these deals we've seen, it's been 10 total. So you're fixed at 5, then it floats for the remaining 5. And then the other thing to be mindful of, as you get closer to the repayment date, the maturity date, then if you're within 5 years, then at each year thereafter, within the 5 years, it reduces your regulatory capital by 20% per year. So if you have $10 million outstanding each year, if you're within 5 years of the maturity date, you may have the $10 million. but the amount that gets counted as regulatory capital will drop 20% per year. And the reason for that is because you're approaching the time period which you have to write a check and pay off the debt, like any borrowing a credit union may have.
Is the structure such that it's a sort of like a line? When you get the sub debt, it is issued, you take the capital and then you go from there? Or can you get sort of approved and ready to draw on it if you need it?
Well, that's a great question. So let's talk a little bit about process for those who want to do it. So the way it would work is you have to get pre-approval from your regulator. So if you're a federally chartered credit union, it's going to be the NCUA. If you're a state chartered institution, it's going to be the NCUA plus your state regulator. And you have to get pre-approval before you can issue sub-debt. So you would go in on your application, you have to submit a business plan. What are your plans to use the proceeds? How do you plan on service the debt? The NCUA, the regulators are sort of going to look at when you think about how much debt to equity ratio. You can't do more than 100% of your net worth. You generally don't want to be above 50% of your net worth as sort of as a mark. Not saying you couldn't do that, but that's kind of a good starting point when you think of sort of the how much. So you go in on pre-approval, and once you get pre-approved, then under the new rules, you'd have 2 years to issue the sub-debt. So what we've been counseling our clients to do is you're thinking, well, we probably could use 5 million. Maybe you go in for get pre-approved for like 6 or 7 million to give yourself a buffer. Now you've gotten pre-approved for a higher amount. Once you get to that point, you could then do it incrementally. You could do it all at once. You just have 2 years to do it. And then once that 2-year period ends, then you have to go back in and get pre-approved again with the NCUA and your state regulator. That's the typical process. And then what will happen is once you get pre-approved, you're going to be working with, they call them placement agents. And we have good relationships with placement agents because you got to find, okay, well, who's going to buy the debt or who's going to be our investors. So it has to be accredited investors because this is a securities offering to be exempt from SEC filing requirements, which we can't file with the SEC as a credit union. And so it's going to be an exempt offering. And typically the other investors are going to be other credit unions. I mean, that's sort of the pool who's going to actually buy it, but you certainly can have other banks, insurance companies. And so what placement agents will do is they'll go out and they'll actually place the debt, the borrowing. We call it building the book. So the credit unions can sort of set the parameters. When you think of pricing of sub-debt is what's the interest rate? That's really it. Obviously, the market's going to drive that. But certainly, if the credit union board said, look, we're not going to do sub-debt, we don't want to pay more than 4%, they can certainly do that. And then it'd be on the placement agents or the investment bankers to go out and sell it. Now, they may come back to the credit union and said, well, at 4%, you wanted to raise 10 million, we can only get 5 million at 4%. You have to up it to, let's say, 4.5% to get the 10 million. And they can either decide yes or no to proceed. But generally, the credit union kind of determines the rules of the road. It's not, oh, we gotten pre-approved, we have to go out at X% and sell it. They can set the parameters of the market because it's an offering. But you got to get pre-cleared by your regulators first.
Tell me about the length of time each one of these stages take. I imagine that with a January 22 go date for the $500 million plus credit unions, there's probably a lot of larger credit unions getting pre-approval right now. Is that right?
Yes. We have about a half dozen right now that have filed an application with the NCUA. So the general timeline to do this, figure it's going to be about a 5-month process from start to finish. And you kind of look at various phases of the offering. So the first month is generally education, learning about, what is sub-debt and kind of what we've talked about earlier in this discussion, determining how much we want to raise, what's the market interest rates are. I think credit unions are thinking, how can we leverage that? If we're going out and we're paying 4 or 5% on our capital, can we leverage that? Can we make that creative to our business? That's generally like the first. Then the next 2 months thereafter is putting together your business plan and putting together the application that you're going to be filing for pre-approval with the NCUA. And again, if you're state chartered, your state regulator. And then once that application gets on file, the NCUA takes about 60 days to get back to you. And they're going to say, yes, you've been approved, or they may provide comments and more questions. And then on the legal side, what our role would be is, again, because of the final rule, and they've sort of more formalized the process, part of the pre-approval application, the credit union will have to create an investors relation policy. And that's going to sort of govern things like practical questions like, okay, once we issue the debt, are we mandated to disclose any information about our financial performance? And you're not mandated. But it will kind of govern what happens if an investor calls another credit, hey, how are you doing this quarter? you got to be careful because you can't have selective disclosures to one institution versus another. I mean, that's a securities law issue as well. So the policy would be created as part of the pre-approval application. We would create sort of a note purchase agreement and the promissory note. Those are sort of the legal documents that are going to effectuate the sub-debt. We'll also do a little offering circular as well. And all this is required by the final rule. And the offering circular, I like to call that, and I told you so, Doc. For example, we would have a section there called risk factors, describing the risks associated for an investor purchasing or investing in sub-debt. And that's all designed to protect the issuing credit union. So all that's going to be part of the pre-approval phase. So then we fast forward, we get pre-approval, and now you start your 2-year clock to issue the sub-debt. So a lot of the institutions we're working with now, they're ready to issue right away. And generally, you're going to have your placement agent in place or your investment banker who would assist placing it, particularly if you're doing a larger amount, like 10 million plus. That phase will probably take about 3 to 4 weeks. So they'll go out, they'll have potential investors sign NDAs, non-disclosure agreements. Then the placement agent will put out what's called like a teaser, just at a high level. Or here's what we're going out with. Here's the interest rate, general information about the credit union. And then the placement agent will do what's called building the book and say, okay, if you're going out, how much can we raise? What are the rates? Once we have that in place, then we have all the investors sign the note purchase agreement, the promissory note, and you close. And so probably from start to finish, about a 5-6 month process. One thing I'd recommend for credit unions that are sort of on the fence or looking to be strategic is you have 2 years to issue. Getting pre-approved is going to take a few months. You might as well get the pre-approval, and then you can always decide, well, let's issue the debt or let's not issue the debt. You really want to try to avoid, and we talked about this in our previous discussions, Doug, just-in-time capital. Because let's say you find a bank you want to acquire or a fee-based business, and you need capital to do that. Well, if you start the process from the beginning, now it's going to take 5 to 6 months. Versus if you've already gotten pre-approved, now you can get the sub-debt in a matter of weeks. So I always say, look, maximize the tools in the tool chest, particularly if you're looking for strategic growth opportunities. And this is certainly one way to do that, both for low-income designated credit unions and now these 500 million plus credit unions, even if they don't have that low-income designation.
Is there any effect on the credit unions or ratios or reviews, metrics of any kind from being pre-approved? Does it have any effect?
No, it's not going to help your capital until you actually issue it. I think where it's helpful, and I know this has come up a lot in M&A transactions we've been involved with. I know banks looking at potential merger partners. I know credit unions viewed more favorably if they have the pre-approval and they can access the capital markets, because now it just strengthens their ability to pay, because you're going to have to go in and pro forma. And this is certainly going to be a hit to capital when you're acquiring a bank. And now the credit union has a way to get that capital back vis-a-vis sub-debt. So in that regard, it's very, very helpful from a strategic standpoint.
Estimate for me, if you would, costs. We've got some timelines. The pre-approval process goes on 5 months. Included in that 5 months is the time to get the issuance of the capital. And there's an investment banker involved, and that generally doesn't come cheap. So you can give me any ideas of what sort of cost the credit union's looking at?
I would say roughly your total deal cost is going to probably be about 1.5% to 2% of the amount of capital you're raising. And I know we have some relationships on the business plan side and with placement agents, but generally that's going to be the typical expense. Now, the one benefit from an accounting perspective, and I'll put my accounting hat on, is that credit unions, you could capitalize those costs and net those costs against the proceeds of the offering. So it's not necessarily a P&L expense to the credit union. So that's a nice benefit too, because you can roll a lot of that into the proceeds. So if you raise 10 million and your expenses, let's say, were $500,000, then you're just looking at, we got 9.5 million. It's not, our non-interest expense went up by 500,000 to do this. It's a little bit of a process because, again, you got to keep in mind too, is this is a securities offering as well. So you're going to want to have sophisticated counsel, a sophisticated placement agent that's a registered broker dealer with FINRA, which most investment bankers are. I know we've worked with some credit unions that have worked with advisors that don't meet that criteria. And you really don't want to do that because, again, the NCUA really emphasized in their final rule that this sub-debt, even though, as I said earlier, it's a borrowing, practically speaking, legally, it's a security. It's a securities offering. So you just want to be careful. I know the NCUA is going to be very cognizant or really reviewing like who are the advisors the credit union's looking at or using, which you have to disclose to them in the pre-approval application that will be submitted. That's an important piece of it as well. That's why there's going to be a little bit more cost.
Jeff, have you seen credit unions get turned down for pre-approval?
So far, no, I have not. But I think one thing we always recommend is to have pre-filing meetings with your regulators. You want to talk to the NCUA, you want to talk to your state regulator, say, look, here's what we're thinking. Here's the amount of sub debt we want to do. What are your thoughts on that? Not necessarily going to say yes or no officially, but they could give you some guidance. Well, I think that's going to be a little too much. Well, that's going to be not enough. Also, too, it's going to be looking at the business. Why are you doing this? What are the use of the proceeds? How are you going to service the debt? It's going to be an added cost, but hopefully what you're going to show is even though we're paying X% on this capital, we're going to be able to leverage that and it's actually be more accretive to our earnings and enhance our ability to grow. I mean, that's kind of the story you want to present to the regulators.
Don't be surprised. You're not going to be surprised in getting turned down because you've tested the waters in advance. That makes good sense. Talk to me about the subordinated nature of this capital.
Yeah, really what this would come into play is, let's say the credit union liquidated. You're sort of at the end of the line compared to, let's say, the members, because they're going to have a membership interest in the credit union. Even though it's debt, it's got a lot of characteristics as preferred stock, which is why it gets favorable capital treatment. It's a more pure form of capital than credit union going out, hey, I'm going to go borrow $5 million from a credit union or a bank down the street. So that's why it's subordinated in nature. That's why, for example, it's not callable for at least 5 years. That's why it has to be unsecured. There's certain requirements that the debt has to meet. Like if the credit union defaulted on the sub debt, the borrower, the investor necessarily couldn't come after. There's certain requirements that you have to meet, but it's really designed to be treated almost like equity than debt for regulatory capital purposes.
In the credit unions you've worked for or even heard of, is there situations that you can imagine where sub debt would not make sense?
One is if your net worth is too low, because there could be some safety and soundness issues to that. Or if you don't have the earnings to support it, I would say maybe sub debt is not necessarily for you as a credit union. The flip side of that is if your net worth is quite large or you have excess capital, sub debt may not make sense for you as well. The other thing to be mindful of with the final rule is you cannot be an investor in sub debt and an issuer. So for a lot of credit unions, let's say who have like 14, 15% net worth and they're looking for yield, they'll love to be an investor in sub debt. So if you're a credit union that wants to invest, then you're not going to have the ability to issue. The NCUA was very strict. They did not want somebody having sort of reciprocal arrangements where you're an issuer and you're a borrower. Banks don't have that restriction. Credit unions do under the final rule.
Very interesting. This subject is really new territory, certainly for me, and I imagine for a lot of credit union leaders. Where can our listeners learn more about this subject, and what would you suggest next steps be for interested parties?
Well, I think education, one, not to be self-serving, but we obviously do a lot. My law firm, we do a ton of sub-debt offerings. I'm always happy to do strategic planning discussions. I have a white paper on the topic. We have relationships with placement agents as well that can have discussions with the credit union. I always think education is a great starting point. Understanding what is it, how does it work, what's the process, how much we should be raising, start introducing those concepts to boards and management teams. I think that's a great starting point to kind of get to the next phase. Now we understand it better. We have an idea of how much capital we want to raise, how we're going to utilize that capital or that sub debt. Now let's get to the next phase. Let's start doing it. That's been the typical process with our clients. Is a lot of planning, discussions. Happy to be a resource to any of your credit union audience out there that wants to have discussions about it.
As you might know, we're big fans of white papers at Act Advisors. We just produced our first white paper. So I love the idea of sharing that with our listeners. How would they get access to the white paper to begin to learn more about sub debt?
Sure. We have a white paper on it that goes into the nuances of the final rule and the process. You can email me. My email address is jcardone@looselaw.com. I think, Doug, you have my contact information. Maybe your listeners reach out to you. You can go on our website and access it at www.looselaw.com.
www.luselaw.com, right?
Yep. We have it posted there, or just as I said, anybody can send me an email and I'm happy to share it. I will say to the audience out there, there really isn't a lot of, in the credit union industry, this is so different and nuanced because it's a securities offering. There's not a lot of information out there. But I think our white paper really would be a great starting point for somebody to look at.
Thanks so much, Jeff.
Thank you. Pleasure to be here.
That's all the insider credit union knowledge we have for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.